Afternoon, everyone. Thank you all so much for making time. It's very exciting to see so many of you today, thinking about your own portfolios and wanting to make sure that you make the right investments as you look forward into 2026. Before I start, how many of you have heard of 𝐓𝐶 before today? Show of hands. Okay, not bad, not bad. Better than how it was when I joined the firm about 2 years ago. Hopefully in the future, there'll be many more hands. Okay, second question. How many of you want to retire? Okay, surprising that not everyone's raised their hands. So actually today I want to talk a little bit about retirement and why 𝐓𝐶 should be someone you consider in your retirement journey. So for those who have not heard of Rowe Price, we're at booth number 10, so please drop by later. But in a nutshell, Rowe Price, we are actually one of the largest investment managers I think you have not heard of. So we run 1.8 trillion US dollars. We were founded in 1937, and in fact, we are one of the S&P 500 constituents. We've also been in Singapore since 1996, so a long time. We've only retail registered our strategies about 3 years ago, so that might be why you're a bit less familiar with us. But hopefully you'll see a lot more of us, and I think there's a lot of very good reasons why you should make 𝐓𝐶 one of the managers that you pay attention to. So why do you listen to 𝐓𝐶 for retirement? So we are actually one of the largest retirement managers in the world. We run over $1 trillion of assets under management. And in the US, we are the largest active target date provider. Having this type of scale has a lot of benefits. We have over 2 million direct plan participants. These are investors who have trusted us with their retirement monies in the US. And their behavior also drives a lot of how we manage our investments. Because we want to make sure what we do will help make their retirement journeys as best as possible. Another thing that 𝐓𝐶 is actually very well known for is very strong investment strategies. So we have the key building blocks that enable us to deliver on this type of a global balanced portfolio, but at the same time to do it in a very unique way that addresses the retirement problem that many of us have. So before jumping into the solution itself, I just wanted to talk a little bit about retirement in Singapore. So I think when you think about retirement, everyone always jokes about it, talks about it, but I think not enough planning ever goes into it. When you think about retirement in Singapore, I like to joke whenever you have a big hong pao or a toto draw, right? So Chinese New Year is up in a month. There's always a very big prize. I'm sure everyone around here has a friend or relative that has said, if I strike Toto tomorrow, I will retire and travel the world, right? We've all had that. So retirement is always front and center. But the question is, how do you get there? And even though it's a very personal choice, I think it's always curious to and better informed to understand what the rest of Singapore are thinking, right? So before we commissioned these funds, we actually had a retirement survey that we ran in Singapore. This was in Q2, Q3 last year. What we did was we surveyed 1,000 respondents, and what we have done as well is to make sure that they are representative of the Singapore demographic. So we have low income, high income, young, old, male, female, and individuals of all different ethnicities to be a representative survey of what I would say Singaporeans look for. There are a few key points that we take away from this. So number one, retirement is becoming much more flexible. Yes, the government says the statutory age is 63 and you will get to 65 in the coming years. But it doesn't matter if you want to retire tomorrow, right? Maybe you are the one that strikes the hong pao draw, you have the $10 million and you decide you wanted to stop working. That could be you. So why does the 63-year-old apply to you? We have a solution that addresses that as well. So what we actually have observed is that a lot of individuals are now thinking much more of what we call micro-retirement and unretirement, and I'll elaborate a little bit more. The second point that we found is that respondents say that they think they need 1 million Singapore dollars to retire comfortably. I assume many of them are thinking of them in today's dollars, but for some of the younger ones in the crowd, it is something that is also might not be enough if you stretch it out long enough into the future. Who remembers in primary school when the plate of chicken rice only cost 50 cents? Right? That doesn't feel that long ago. But comfortably now, the plate of chicken rice will be easily quadruple that amount in the primary school. And sometimes if you are in the CBD, you need close to at least $10, right? So inflation is something that eats away. And later I have a chart to show you guys that you really need to start planning for this. And last but not least is that people say they don't understand all the retirement options available to them. So we just discuss it a little bit briefly and segue into the solutions that 𝐓𝐶 is going to offer. Okay, so what is micro-retirement? You can think of it as taking a career break, but one that is much more planned and much more deliberate, right? So I actually have an ex-colleague who's on one of these micro-retirements now, and she's traveling the world, somewhere in Antarctica, looking at penguins, and we're all really jealous of her. But she's done that after generally building up a nest egg of a few $100,000. And a lot of individuals that say they want to have this micro-retirement of, call it 6 to 12 months, they are doing that. Be it whether for their plans to travel or plans to spend time with family. This is something that we are observing more and more in Singapore. But when you take that break from work, what I want to highlight is that your income stops for some time. It is very important to think about replacement sources of income or to have a proper plan to factor this break as you think about long-term wealth accumulation to fund both your retirement and legacy plans. Another thing we've observed is unretirement. So official retirement age, again, 63. But many individuals want to continue working. Many in Singapore actually do this because they want to stay active in their mental state. And that's a very positive thing because globally, a lot more people do this because their money has run out. So what it means is that people come back sometimes to the same field or to something aligned, but they work much less. So maybe they take a pay cut, maybe they do a smaller role, but they still want to do this. So if you have this plan, why should the same statutory age and its associated products apply to you? Maybe it's less appropriate, right? So we are trying to find a bridge and a solution. Second point on the $1 million needed to retire. So the first thing I want to say is there is something called the rule of 72 that you see on the top right-hand chart. Essentially, if you take 72 and you divide it by the annual rate of inflation, be it 2% or 4%, that is the number of years it takes for a price of something to double. So we've taken a few goods as of last year's prices. So bread from NTUC, $3.80. I remember a time when it was a lot cheaper. A GP visit at $100. A Mercedes-Benz, you can plug in a Toyota, it's the same thing. And a resale flat. And what we have done is we've applied the last 20 years inflation rate of 2.2% in Singapore and the last 60 years of inflation rate of 4% in Singapore and observe what is the price going to be in the next 20 to 40 years. So the one caveat is this is a very simplistic assumption. Obviously, there will be things like TVs over the years have just fallen in price, right? So this is of a basket of goods. But the scary thing is, look at a Mercedes in the worst case scenario. In 40 years' time, potentially you could even have a Mercedes that costs you $1.5 million just to buy that 10 years to drive around. So is that $1 million truly enough? If you are only invested in fixed deposit solutions or cash solutions, potentially it's worth thinking about what is your short-term needs in terms of cash and to consider investing. What is compounding that problem is that we are also living longer and longer, which is generally a good thing. But I have a few scary statistics to share with you. Number one, I see some gray hairs here. If you are 65 today, the probability of you to get to 90 years old in Singapore is 1 in 3. 1 in 3. So if you look around you, there will be many of you that will get to 90. Even more scary is that if you look at the population in general in Singapore, 1 in 28.5 people reach 100 years old. Think about it. There are easily a couple, 300 of you here. 10 of you statistically will get to about 100 plus years old. And if you compound that, with the fact that people want to have a flexible retirement, if you compound that with the inflation rate that I mentioned earlier, maybe the $1 million might not be enough. Just food for thought, not trying to scare. It is important for you to plan. Another finding from our survey is that individuals don't understand or know what they have as options to battle and to save for retirement. So we've just picked off a few of the common things that we found online. Nothing revolutionary. These are all tools that we have in our toolbox to make sure that we fight the potential of inflation and longevity risk, to make sure that we are prepared. I think in Singapore, we are very spoiled because we have an amazing CPF system, but potentially relying on that alone might not be enough. Insurance frequently gives you certainty, but it also reduces a lot of flexibility. If you buy an annuity, typically you pay upfront and you don't collect very high dividends. So on and so forth. So if you look at real estate, I think we all love our houses in Singapore. Rental is not guaranteed. You have ABSD rules. And even if you have been lucky enough to accumulate multiple properties, to then decide to move when you're a little bit more gray, it could mean uprooting yourself from friends. And it might not be something that people want to do given the very long memories that you have formed in your home. So on top of that, I really want to encourage you to use investments as well. I assume many of you here, by self-selection, are already invested in equities and fixed income. But I also wanted to introduce you a solution that I think is very important and potentially a good core building block to your retirement portfolio. And that is the Rowe Price Retirement Allocation Funds. So one last thing that we found from our survey is we asked the question, do you want a retirement solution that automatically reduces risk for you over time as you get older? And overwhelmingly, our respondents said yes. And this is something that we have a lot of expertise in the US. So what is the Rowe Price Retirement Allocation Fund? We've created two portfolios, one for retirees and one for pre-retirees. And there are three key factors that I want to share a little bit about. The first one is they have something called a glide path built into it, meaning that over time, our portfolio manager will systematically de-risk your portfolio from more equities into more fixed income. Because if you think about it, as you get older and older, the ability for you to recover from a shock like the financial crisis or like COVID diminishes. We want to make sure that we keep your nest egg as stable as possible as we approach your golden years. Secondly, is we want to make sure it's agile, because we have observed that people are flexibly moving in and out of work now. So your circumstances might change. We want to allow you to switch between our solutions and also to use the different share classes available to determine whether you have an income or you reinvest your investments. Last but not least, we are offering this in both Sing dollar and USD. And we will have the accumulation, 6% payout and 8% payout share classes. If you want to find out a little bit more about the availability of the share classes, you can head to our booth at number 10 later, and we can elaborate. So some of the key benefits here is you will have the risk-appropriate optimized asset allocation allocated to you based on where you are from your retirement age or your planned retirement age. And this gradual reduction in volatility is something that we have observed is extremely sought after by investors. This is a buy and forget strategy. So I know Marcio gave a very good presentation earlier on PBIG, and among other peers in the room, many of them offer you multi-asset solutions. We would say the traditional multi-asset solution addresses all the bottom row risks. Volatility, as Marcio mentioned, around what happened during Liberation Day and so on and so forth. It's not wrong, it's right. We've done the same on our portfolios as well. But we also have the two large boxes at the top, behavioral as well as longevity risk, that we make sure we address using this glide path portfolio. This is how the glide path looks. So we use a strategy of T-row solutions, enable our portfolio managers to pick and choose the right building blocks to gradually de-risk the portfolios over time. One thing I want to highlight, which people tend to get quite surprised by, is the relatively high weight to equities at retirement. So you can see retirement date all the way in the middle of this page. We actually advocate for about a 50% allocation to equities when you just retire. And that's because of all the aforementioned longevity and behavioral biases that we have already mentioned. So the two solutions, Retirement Fund 1 are for retirees. Retirement Fund 2, we think, are for pre-retirees. They will move gradually over time through this glide path. And I think that is something that is quite unique, and people tend to try to understand a little bit better. So we have tried to pictorially show you how the equity weights will move over time, and the flip side of this will be fixed income, right? So we launched the funds about 6 months ago, both Fund 1 and Fund 2, and they've actually done very well. The Retirement Fund 1, which is for retirees, has already delivered 8% of returns in dollar, and Retirement Fund 2 has delivered 10% of returns over the same 6-month period. But if you look at the static allocations in 2025, you can see Retirement Fund 1 at 51% equity. As we move over time in 2030, you would reduce gradually your allocation to equities to 48. 5 more years, it gets to 45. 15 years later, you get to 41. And this gradual reduction of risk is done automatically. There's no need for you to change your investment, to switch, to remember to do something or not do something. This is all done and managed by the portfolio management team at Rowe Price. One of the 2 portfolio managers, 𝐓𝐡𝐞 is even based in our Singapore office. So I mean, if you really wanted to see us, we are in Wheelock Place. We are not that far. If you're ever in Orchard, you can always drop by and see the Rowe office. This contrasts a lot to traditional multi-asset funds, for better, for worse. So taking a 50-50 portfolio as an example, which will look similar to Retirement Fund 1 now, you can actually see that, yes, maybe it's the most risk-appropriate thing for you now, but maybe in 5 years, 10 years, 15 years' time, you actually need to reduce your risk profile, but that fund doesn't do it for you. So you need to actively go in and think about rebalancing it yourself, instead of having this totally automatically done for you. And that is the benefit of the retirement allocation funds. So quickly on the fund proposition to identify which fund is most appropriate for you. We would ask you, when do you want to retire? You could be 45 years old and retiring in a year's time. We would say that you are just 1 year to retirement. Or you could be 60 and wanting to retire in 10 years. We would say you're 10 years to retirement. Or you could be the lucky chap who struck Toto at 35 and is already retired. Then we would say that you are on the right side of this chart. So that's how you really identify where you are meant to be based on your risk level or profile. But of course, this is just a recommendation, and it's not to say that you cannot then invest in the other fund if you so wish to. Or if your circumstances changed, you can also switch between the 2 funds and switch between the various share classes available to you. In order to grow your nest egg the best, we would recommend an accumulation portfolio. But if you have a kid who, for example, is going to university, you can also use the income-paying share class to then fund the university education and switch back once he or she graduates. How the fund looks in 5 years' time, it basically glides down that glide path, hence the name. So in 5 years' time, you can see that Fund 2, which is the pre-retirement option, has gradually moved down, and it now has about a 55% equity weight. And Fund 1 has now moved to about a 48% equity weight as the base case. One thing I just want to highlight here is that we also do tactically add and reduce to fixed income or equities based on our views. So this is not going to be a static buy and sell because we think that because this is done by the glide path. We will also make a lot of active decisions on where we want to slightly be overweight, for example, in equities today. And if in the fixed income markets, we might also want to take and express certain views, this would all be put into this strategy. So you can think of this strategy truly as one of the buy and forget type strategies. So this is how Fund 1 looks like right now. This, I think it's end of November. You can see that it is very well diversified, right? Equities at the moment slight overweight versus the 51% initial that I mentioned. Fixed income slight underweight to fund that overweight. And you can see we are very truly a global portfolio. And the performance has been very compelling as well since we launched. Given the lower risk profile of Fund 1, delivering 8% over the last 6 months is truly one of the better performing solutions. Fund 2 is then a little bit higher risk for the pre-retirees. But what I want to say is that within the equity and the fixed income sleeves, they will be mirror images. So for the Fund 2, we will dial up the amount of equities, but in the same proportions. And then again, on Fund 1, it will be lower, and so on and so forth. So just some of the fund details. These can all be found on Fund Supermart's platform. The 8% share classes, I think we have just launched, so they are not yet available, I believe, but it should be on there by the end of the month. The one caveat is that if you do take a high income, that would then come from the total return as well. So these are share classes that we will commit to pay either 6 or 8%, and we will reset the payment amount on a 6-monthly basis. Okay, so key takeaways. I think the first thing is retirement is very personal, right? It's not determined by age. It's really your own personal circumstance. I think we all wish that we can retire young, all wish that we can explore the world a little bit more while we are still healthy. And that is something for you to decide, but I would advocate planning around it. Secondly, it's just to stay flexible, because this is a core building block of potentially your retirement portfolio. But it is important to also think about all your assets and liabilities and your goals as well. Do you want to leave a legacy for your children, as an example? That would then factor a lot into how you would use these portfolios to round off what you already have in the traditional space. And last but not least is really the behavioral aspect of things. This is an open-ended daily dealing fund, meaning if you buy today, you can sell tomorrow. But this is a retirement portfolio. The idea is to invest for the very long term. And this will help you stay aligned with your risk perimeters. But if you were then going to look at the markets and say, oh, it looks very toppish today, maybe I should redeem, you can then very easily fall into a situation where you might not achieve the optimal portfolio because of certain types of investor behavioral biases. Okay, with that, I think I'm at the end of my presentation. So thank you all so much already for your interest in our strategy. If you'd like to hear more about Rowe Price, our funds, as well as the retirement portfolios, we're at booth number 10. So please feel free to drop by and say hi. And thank you again for making time this afternoon.